At the end of this presentation, I am going to give you a download link to download some papers that I've written so that you can follow along with this presentation in text, as well as a video series, and it's all complimentary. That's going to go along. Since I have a limited amount of time, I'm going to give you an introduction, but it's more about me getting you the information about how to do these diagonal spreads than for me to sell you stuff. And I wrote it up in a really nice white paper that was published recently on a whole bunch of different sites like MSNBC and Bloomberg, and I just want to get you a copy of that white paper. So let me first give you a couple of ground rules here with the webinar system. I don't know if somebody's already done this with you, but I do like to make sure that you can interact with me because it makes sure that I understand if you're hearing me. So look at your webinar software. It's the little stuff that's running in the upper right-hand corner of your screen. And the first thing I want to make sure you see is there's an orange button with a white arrow on it. And if you see that orange button with the white arrow on it, what that does is it shrinks the webinar software off of your screen so that it doesn't take up valuable screen real estate. And I'd like you to go ahead and click that. You could always click it again and it brings the webinar software back. But when you click it, it frees up that valuable screen real estate. In fact, I can actually, I have a slide that explains that. Let's see if I can find it right here. And I call the little thing that remains your grab tab or your compacted view of the webinar software. It's just a couple of buttons that stays in the upper corner of your screen. And the other thing I recommend you do is there's a full screen button on that grab tab, on that vertical column of buttons. Click that too so that my screen takes up your screen, because I'm going to do a lot of graphing and charting and explaining today, and I don't want you to have to squint. Does that make sense? And also, one last thing for housekeeping is on that grab tab is a raise and lower your hand button. And I'd like you to, you know, what Renee has outfitted me with here is a kind of classroom admin panel where I can see all your names and I can tell whether your hand is up or your hand is down. So if you could do me a favor, could you just raise your hands for me and make sure I know that you know how to click on that button, and also see how many of you are actually really paying attention, how many of you kind of put this on in the background and you're doing something else and trying to multitask. Awesome. Welcome. Welcome those of you that are engaging with me. I really like to engage with folks. So, and then notice, by the way, that your hand raising button changes shapes on you. And so it tells you whether your hand is up or down. So now let's see how many of you can take your hand back down. Awesome. Awesome. All right, so I'm going to ask you throughout the session to make sure you got comprehension on what's going on here. And remember, at the end of this session, I'm going to give you a download link where you can go and grab the white papers that go along with today's session, as well as a video series that explains it more than what I'm doing today, because this is good information. All right, so first things first, I do like to introduce myself. This is me. Actually, this picture was taken about 8 years ago, so I'm a little bit older looking. I just turned 44 in May, so I'm going to be, I got quite a few more grays than is in this picture. How many of the show of hands have ever heard of me before? I have been trading options since 1997. I've been running Trading Trainer since 2003. It's one of the longest options trading school that's been going through all the different downturns. And besides that, let's get right into the discussion. And this discussion is how to do diagonal debit spreads and why they're so awesome. And I'm going to go off script here. I'm actually going to step back from the slide set. I'm sure you've seen enough slide sets to last you a lifetime here. So instead, let's actually pull into some thought process here. I'm going to freewheel it here with some notes. So I want you to please be prepared to take your own notes here, because I think you're going to get a lot of value out of this afternoon's session. Before we understand really how to do these diagonal debit spreads and really consistently make profit, what we want to understand is how to construct them, okay? Because it's not hard. Once you got it down, it's not hard. In fact, I've got a whole program, we call it the 6% protocol, that this is what we do. We sell premium in the form of diagonal debit spreads, and we aim to add 6% to our portfolio each and every month. Now, truth be told, over the last months, the participants who have been reporting back to me in this program have been saying that they've been reporting back that they've been doing 11 to 25% on their portfolio for the last 4 or 5 months. And so that's really exciting for me that we're beating our intention of 6% every month. But with that said, this is how we're doing it. So first thing you have to understand is when you look at the price of an option. So if I were to open up a browser window and I was to go visit a free site like the CBOE, Chicago Board of Options Exchange, and went over to their quotes and data column and just looked up a price of an option. Go to their delayed quotes and pulled up, I don't know, what's a good stock that we should look at? Let's look at the CBOE stock, Chicago Board of Options Exchange. And you look up an option price. For instance, right here, this is our September $100 strike price call option, and it's trading somewhere between $1.35 and $1.50. Last time it traded was $1.11. When you look up that price, you have to realize what that price is actually constructed of. What does that price actually mean? Let me write down a little formula for you. This isn't rocket science, but the price that you look up is equal to something we call the intrinsic value plus the premium. Now, you might have heard of different names for that premium. Some people call premium extrinsic value. Usually those are academic nerds like yours truly. And some people call it time value, but I don't like to use that name. It's a misnomer because it's got a lot more in it than time. All right. So whenever you look up a price, there's these two components in that price, intrinsic and premium. Intrinsic, a good way to think of that is what's left over at expiration. It's some people call it the real value of the option. It's the actual tangible value. If an option's in the money, it's going to be worth something at expiration. If it's at or out of the money, it's going to be worth nothing at expiration. And it's all the intrinsic value. In fact, you can calculate the intrinsic value at any time by simply taking whatever the underlying security is trading at. For instance, CBOE is trading currently at $100.39, and subtracting out the strike price, because that's how far you're in the money. In this case, I'm 39 cents in the money. That's the intrinsic or the real value of this option at expiration. At expiration, this will be worth 39 cents. How many with a show of hands follow? Awesome. How many with a show of hands have I lost you already? Good. In fact, if I were to use, for instance, the 105 call option, and the current price is 139 cents, the intrinsic value would be 0. There'd be nothing left over. It's not worth anything at this point. And if I was to use, say, for instance, this 97.50, well, I've got $2.50 plus this 39 cents. I got $2.89 in the money. That's the intrinsic value. Now, obviously, that formula I gave you kind of rings through, because we could see the price of these different options are not $2.89. It's trading somewhere between $3.20 and $3.50. The middle price would be something like $3.35. This one's trading somewhere between 135 and 150. Something like $1.42 would be right there in the middle. And yet we said that there's 39 cents of intrinsic value. So the rest of it is premium, time value. So if you were to look at that, for instance, graphed out, and I happened to do some graphing this morning in preparation for this call. This is the intrinsic value, and this is not a $100 strike price. This is a $50 strike price. And so anything below $50 has no real value in this option. And then at $50, we move dollar for dollar. So if it goes to $51, there's a dollar of intrinsic value. $52, $2. So it moves dollar for dollar with the underlying symbol. Let's stop right there. How many with the show of hands are following? Awesome. Awesome. Now, we were talking about this actual option price. And so when you talk about that actual option price, what you're talking about is this premium value being added on top of the intrinsic value. And this premium value, when we're doing a diagonal spread, is what we're actually selling. Okay? So you got to, when you start thinking about option prices, I want you to think about them in two components, two different pieces. This real value, the intrinsic value, and then the premium or the extrinsic value, okay? Because depending on which options we choose to populate the components of our diagonal spread, we can actually get this thing to be optimized appropriately for the trading strategy we're going to do. So for instance, if I go very deep in the money, you might notice, or deep out of the money, you might notice that there's no time, there's no premium, there's no extrinsic value out that far in either direction. So going far out in the money makes it worth 0. Going far in the money makes it just the intrinsic value. Let's stop right there. How many of the show of hands are following so far? And by the way, don't get too carried away with taking notes, because like I said, at the end of this little presentation, I'm going to give you a link to pick up these white papers, no charge. I just want you to have the knowledge. These white papers that I've published and some video series that'll take you through it more thoroughly than I have time to today. So I want you to have that, okay? So don't worry about taking too much notes. Just wanted you to get the gist. All right, so we have to know that whenever we think about the options is that it matters how we select these options when we're doing our strategies, because we can get them to behave differently. I can get them to behave like a replacement to the underlying symbol that moves dollar for dollar with the underlying symbol if I go deep in the money. Or I can get it to behave where it has no effect of the underlying symbol and instead is all this premium based on time and some other factors. So actual selection of the option to populate my strategy makes a big difference. All right. In fact, if I were to subtract out the intrinsic value component of an option price and leave you with just that premium, here's what it would look like. It would look like this hump. And notice, again, we're talking about the $50 strike price. Notice that the maximum premium is right at the money. And then on either side, it goes down to 0. It actually goes down to 0 the same way on each side. And actually, this premium, even though I wrote up here call option in my graph, here's something really interesting. This is the same exact picture. There might be some variation depending on what the risk-free interest rate is, but that's a whole different discussion. For the most part, this is the exact same picture. The premium is going to be the same on a put option or call option. See, there's some factors, and we got to know this if we're going to do this successfully, because a lot of people just jump into diagonal spread trading and they don't quite understand what the heck they're really doing, and they get themselves into trouble. How many with a show of hands have gotten into something with investing and you didn't quite understand it and you got into trouble? A lot of hands are going up. That happens a lot. So it's good to understand actually the mechanics of what's happening. So let's make sure we understand that in depth here. And that is, when we've got our extrinsic and intrinsic value, the intrinsic value is a function of, let's go back and look at the picture. Obviously, if this is the underlying stock price along the x-axis and this is the intrinsic value price along the y-axis, the intrinsic value has something to do with the underlying symbol price. And it has something to do with the strike price. And it has something to do with the option type, whether it's a call or put. This, by the way, is the intrinsic value for a put option. And this is the intrinsic value for a call option. So the call option increases in value dollar for dollar once you hit the strike price, and the put is the other way around. It goes when the underlying symbol goes down in price below the strike price, it goes up. It has an inverse relationship. So that's how the intrinsic value is affected. In fact, some of these things, the strike price and the option type, it doesn't change. So really the intrinsic value component of the option price is only affected by the variable of the underlying symbol price, because these things don't change. I've never seen an option metamorphosize from a call option to a put option. Doesn't happen. And an option doesn't change strike, surprisingly. And I just thought of how I just contradicted myself. Sometimes when there's a split in the stock, but that's a corner case. All right, stop right there. How many of the show of hands are following with that explanation of intrinsic value? So then let's talk about the premium. The premium value, if we go back and we look at that picture all by itself, the premium value is a function, of course, it looks like the underlying symbol price. The premium value is also a function of how long we have until the thing expires. So here's that extrinsic value, or that premium, and you can see that it gets less and less as time gets closer to expiration. That doesn't happen to the intrinsic value, by the way. That only happens to the extrinsic value, or the premium. So the premium is a factor of time to expiration as well. And just as a side note, you may already know this perhaps qualitatively, but I really want to go to your Google on your own time, of course. And when you're at Google, type in option time decay curve. Why not? And I like Google Images better than I like Google just because I don't like to read. I like to look at pictures. And pick one of these images. They're all about the same. And you'll notice that what this is telling us is that the premium, the extrinsic value, goes down exponentially. So if we want to actually make some fast returns off of our premium, it might make sense to get involved here. I guess my question for you would be, in the same amount of time, 30 days, how many of you with a show of hands would rather make this amount or this amount? This is the option value. So who wants to have the smaller amount? Raise your hand. Who wants to have the larger amount? Raise your hand. By the way, I see a question in the Q&A area that I just can't not address. Somebody said, hey, I'm not an options guy, so I'm checking out. And let me tell you something. Be very careful branding yourself as a long-term investor, short-term investor, option guy, Forex guy, because I'll tell you, this particular diagonal strategy is a long-term or medium-term investing strategy. It's not an options day trading thing. In fact, the people who are participating in my program, the biggest comment I get is that they're bored. They're bored, but they're doing it anyway because it's lucrative. Because if you can grow your portfolio by 25% every month and be bored out of your gourd, you'll find something better to do with your time. And it works perfectly for long-term investors. So don't put a mental block up because we're talking about options that you shouldn't listen because you're a long-term investment. They have nothing to do with each other. How many of you with the show of hands agree? Yeah, absolutely. So let's keep going. So this time premium stuff shrinks with time, and it shrinks faster as we get closer to expiration than not. And also there is, of course, another component which doesn't affect us too much when we're close to expiration, but it's the buying and selling pressures of the option. So, you know, if a lot of people want a particular option, the price goes up. It's just like Cabbage Patch dolls in the 80s. When everybody wanted them, the price was out of control. You couldn't even go to Toys R Us and find one. And then all of a sudden, a couple of years later, it was Beanie Babies, and then Cabbage Patch dolls were a dime a dozen. How many of you show of hands follow? So whenever there's buying and selling pressures for something, the price could go up or down. But what's interesting about this thing, and I guess one other thing that we can throw in here as a variable is strike price. But of course, strike price doesn't change. So the things that really affect what the premium is worth is what the underlying symbol price is, the time to expiration, that's ticking away all the time, and any buying and selling pressures of the option, which really don't become effectual on anything that's about to expire anyway. What's interesting is what we said before. The option type doesn't matter. You notice it's not in this list. All right. So a good way to think about a diagonal debit spread and why you might want to be using this guy has to do with substituting in with something that maybe we can wrap our mind around, a covered call, substituting in something for the underlying symbol. And now that we've got a background on options, I think that for those of you that are paying attention, you might be able to see where I'm going with this. So let's talk about just kind of what is a typical strategy for a covered call. Here, I'm going to log into my Learning Community web portal here. And we're just going to pull up a graph of a symbol that I've been trading diagonal credit spreads against for quite some time. Actually, I'm going to use a different username and password. And remember, take some notes during this thing. Guess who doesn't know how to spell the word demonstration? See, I'm a trader. I'm not really a speller. Take some notes today, but I want you to mainly get the gist of what I'm talking about because, like I said, at the end of this presentation, I'm going to give you a way to download the text versions of this presentation so you can read through it and really like wrap your mind about it, and also a cool video series that goes through it as well in more depth since my time is limited here with you. Does that sound like a good idea? If it does, raise your hand. Awesome. So let me come over here. Let me go to my charting. This is the website we give folks access to that are using our program. We'll just do a chart. I'm going to look at one of my charts, and it's going to sound like kind of bummer. It's not exciting. Like I said, most people are telling me that this program is somewhat boring. Give me a second here. It's Kohl's. I want to show you a chart for Kohl's. You know, the department store. No frills. I did it again. All right. Charting. Kohl's. Just a little quick review chart. We'll go ahead and expand this thing to full screen as soon as it loads. Fantastic. So what we like, and I'll put this into candlesticks so you can really see what's going on. What we like when we're selling premium is we like something that has been going sideways and is boring. Okay, not something that's trending, not something that's exciting. We like stocks that are below the radar, capitalized nicely, and just go sideways. Pay their stockholders a dividend, and they don't really care about asset appreciation, and they're just running their company. And Kohl's is one of those companies. And as you can see, I'm looking at a 2-year weekly chart. That means each one of these candlestick bars is a week long, and you can see over the last 2 years, we've traded about between $40, $45. At one point, we got as high as 55, but after a few weeks, we came right back down. Okay, so this is a nice type of stock that we like to sell covered calls against or write diagonal spreads against. You look for something that has a clear line of support and a clear line of resistance. And when I say clear lines of support and resistance, and of course we can go into all kinds of technical analysis that time won't let us, but again, in that video series and in the white paper that you can download at the end of this presentation, you'll get all that information. But we like to see that it's been tested, meaning there's been reversals at these various lines of support and resistance. And ideally, when you do a covered call, and this is a misconception, a lot of folks associate covered call writing with what we call buy right, which means you buy a stock and you sell premium against that stock, you sell a call option against that stock all at the same time. And in truth, what we like to do is find one of these candidates that's been going sideways for years and we like to leg in to our premium trade. We like to identify a bottom at the level of support we identified, and that's when we buy our stock. So we get it at as low a price we can after the threat of dropping through support has happened. And then we wait until a top has been found at our resistance level to sell the premium so we can get as much as possible. And here's the thought. If you've got a tested level, and it's amazing how many folks I've talked to who have attempted to do some sort of premium trading don't get this basic concept. So I want to make sure we're all on the same page. Your premium that you sell, the strike price you sell, should be slightly above your tested level of resistance, because the idea is that you do not want to get called out every month. And you might say, well, when do I realize my profit? Here's why you don't want to get called out, and here you should take a couple notes. Reason number one, the calculation for return on invested capital. The calculation for return on invested capital is profit divided by investment. Every cycle where you sell premium and then it expires worthless, and you sell premium again and it expires worthless, and premium again, every cycle you make profit, but at the same time, you're reducing the denominator of your equation by the amount of profit you made the previous time. In other words, your cost basis, your break-even price gets less and less every month. And so what happens is, instead of a return on invested capital that increases linearly month after month, or if you're doing weekly options week after week, whatever your cycle length is, it actually winds up increasing exponentially. I try to stay in my premium trades a minimum of 4 to 5 cycles. That's my average before I get called out. And on the flip side, my max has been 14 months, 14 cycles. So I try to stay in as long as possible, because I know every month I'm in it, my ROIC is going up exponentially. So that's reason number one. Reason number two is, once you find one of these stocks or ETFs or whatever you're selling premium against, whatever you're using a derivative to sell premium against, once you find one that's behaving the way you want to basically marry this thing. You don't want to spend time looking for another one. It's kind of like a good partner. Once you find a good partner, stick with that partner. So long as it behaves as it's expected, why always look for a new partner? Not necessary. So we like to find these good candidates that we can trust will keep putting money in our pocket cycle after cycle, month after month. And we don't want to have to keep researching new dancing partners. So 2 reasons why we like to stay in these things as long as possible. So when we sell the premium, we actually want to sell a strike price slightly outside of our resistance, because our intention is to not get called out. And our intention is, if this is the strike price, our intention is to sell it right about here, again, because we don't want to get called out. We'll get as much profit as we can, but not get called out. Now remember, when we sell that premium, it becomes an instant dividend, a profit buffer on our cost basis. So whatever we paid for the underlying symbol minus that premium will be our cost basis, our break-even price, and ideally, we want that break-even price to fall below our tested level of support. Getting a strike price for the sold premium above our tested level of resistance and a cost basis means that we have a risk-free trade that can go on cycle after cycle, and every month it gets better and better. And that's the ideal for writing covered calls. But now we've discussed in the first part of this webinar how we can tune options to actually behave like stocks. If we take an option and we go so deep in the money that the extrinsic value has gone to 0, in effect, this deep in the money option will behave dollar for dollar like the stock. It's a beautiful substitute for an underlying symbol. And usually, rule of thumb is when you go this deep in the money so that there's trading at parity, there's no extrinsic value left in the option price, that option will be about 1/3 of the price of the underlying symbol, which means that it opens up this investment to quite a few more traders, a few more investors, a few more long-term investors. We reduce our cost basis, our premium stays the same. So here's the equation, just in summary, and then I'll get you the link in order to get all the details behind this strategy and how this strategy winds up being very lucrative, but being boring and quite the target for the long-term trader. And that is substitute the deep in the money call option for the underlying symbol in a covered call strategy, where once we've identified a symbol to trade against, we buy the stock replacement. Now it's called a back month option at the low of the channel. We sell the premium at the high of the channel. We've now created for ourselves a diagonal spread. A diagonal debit spread, by the way, does not require margin. Many brokers will allow you to do it in a retirement account. And these trades basically take visiting for a couple seconds every evening just to see what happens. And that's about it. The diagonal debit spread with its lower cost basis creates greater returns and reduced risk. One last question I get a lot of times is, what about strike? What about expiration date for this back month option? What do I do with that expiration date? Well, I told you that on average, I'm in these things 4 to 5 months. And my max in the last 20 years of trading, I just had my 20-year trading anniversary. I started when I was 24 years old. Has been 14 cycles or 14 months. So not only do I want to deepen the money call option, I want to go far out in time with my expiration date. On calls, I'm currently trading against a January 2019 expiration. See, I want to be called out. I want to be pulled out of the trade before my back month option expires. So I'm going to think for the worst case. Worst case was 14 months. I'm going to go out as far as I can. Many of the symbols I'm interested in have leaps. The January 2019 expiration date is fantastic. It's the third Friday of January 2019. I go deep in the money. Every cycle, I sell a new premium. And this becomes a very lucrative trading strategy. How many of the show of hands have followed? Excellent. Excellent. So here's what I'd like to do. I'd like to give you a link. Let's see if I can make this link nice and big for you to see. This link will bring you to a place where you're going to give me your email address, and I'm going to email to you my white papers. And I'm going to sign you up to be able to watch the videos. In fact, let's test this, because I just set this up this morning, so I want to make sure it works. Perfect. So you'll come to a page that looks like this. You'll put your email address in, and you'll get immediate access to the videos. And one thing I recommend you do is watch those videos to the end, because then you'll be able to click to the next video. There's 4 videos, and you might as well watch them all at once. You don't have to wait for the automatic email system to say, here's video 2 ready. If you get to the end of video 1, it'll click you over to video 2, and so on and so forth. So you can watch all the videos at once. And also check your inbox. Make sure you give a good email address, because immediately the system will automatically send you links to my 2 white papers. One of them is the one we did today. The white paper is called Diagonal Spreads, a lucrative variant to writing covered calls. And the other one is a bonus white paper that I wrote a couple months ago called Scenario Testing, an imperative for bound trading strategies to ensure max profit, minimal risk. These white papers are in my voice, and as you can tell, I'm no rocket scientist myself, so you'll be able to definitely understand what I'm saying. It's not like scientific stuff or anything like that. It's basically written down what we talked about today, but in more detail. Same with the videos. So how many with the show of hands are going to go head over right now and check out, get those videos and get that white paper? Again, no cost, just something I'm really proud of doing. If you have any sort of questions whatsoever, please don't hesitate to email me at aj@tradingtrainer.com. Write that in your notes. And feel free to call the office. If you want to talk to me, you have some thoughts about what we said today or anything else, 970-266-8146, extension 81. Just tell me how you heard of me. You were on Renee's call today. I'll have no problem chatting your ear off.